This liquidation heat map displays Bitcoin's price action on July 27th, detailing a violent plunge toward the 63,500 region. Look closely at the angle of descent. A drop this steep is driven by extreme velocity, triggered by forced liquidations within exchange matching engines. Short-term price action is rarely random. It actively hunts liquidity to execute large orders. Despite widespread assumptions, this midday collapse required no breaking news or external macroeconomic shifts. It was a mathematical inevitability dictated entirely by derivative positioning. To predict directional bias on these tight timeframes, we have to reverse engineer the hidden leverage clusters that create these magnetic price vectors. To see how this setup formed, we rewind to this heat map from July 23rd. The price hovers in a tight range between 65,000 and 66,000. Below, bright yellow and green bands map highly concentrated pools of leveraged positions, what we call systemic counterparty risk. Within the physics of an order book, these dense bands act as structural magnets. They exert a gravitational pull, drawing price action downward to clear out the risk. Retail traders routinely ignore these heavy clusters, scanning news feeds for catalysts instead of looking at where the market actually holds its weight. Before forecasting the next macro move, quantitative analysts must locate this resting potential energy and map exactly where the danger lies. Looking at this early data from July 23rd, the chart clearly shows a downward price trend testing a resting liquidity zone right at the 64,500 mark. That specific geographic band represents billions of dollars in over-leveraged long positions. Advancing the chart to July 24th, the market remains range-bound. Despite minor local price fluctuations, those bright liquidation levels hold stubbornly below 64,000. We define these static, heavy clusters as resting systemic fragility. The architecture of the market is holding a massive, unbalanced load. Traditional models of support and resistance fail to capture this dynamic. They treat historical price floors as concrete walls, missing the magnetic pull these leveraged clusters generate. A core rule of liquidity physics states that price must eventually interact with the heaviest concentrations of counterparty risk to maintain overall market efficiency. This means a vertical crash does not materialize out of thin air. It requires days of visible fragility compounding quietly in the background. By July 26th, this heat map reveals a structural imbalance. Price breaks past 65,000 towards 65,500 without clearing lower liquidity. As the asset climbs, traders eagerly add long positions. Watch the lower yellow zones, they visibly thicken. The market is aggressively loading a directional spring. This creates a psychological trap. Traders see the rising green candles and stack more leverage, completely ignoring the compounding risk profile expanding directly beneath them. Fast forward to the start of July 27th on this chart. The price trends steadily upward, reaching a fragile local peak near the 66,000 level. At this exact moment, the market resembles a heavy steel spring compressed to its absolute physical limit, vibrating with stored kinetic energy. Any upward price action built on top of uncleared lower liquidity is mathematically unstable. The entire structure is perfectly primed for a violent mean reversion. This diagram abstracts the heat map to show the micromechanics inside those high-density yellow bands. Crossing a single price point triggers an immediate cluster of automated sell orders.
The sequence is rigid. Price dips and hits a margin threshold. The exchange seizes the trader's collateral and fires a mandatory market sell order into the book. That single automated sell order consumes the nearest resting bid liquidity. This action mechanically forces the price down another fraction of a percent, right into the next limit tier. Multiply this sequence by 10,000 over-leveraged traders, and you get a liquidation cascade. Thousands of sell orders compound instantly, completely overwhelming the buy side. This chain reaction executes on its own. No human intervention is needed, and absolutely no external news is required. Once that initial margin threshold is crossed, the asset's movement becomes entirely mechanical, governed strictly by the density of the leverage stacked below it. Returning to the live data on July 27th, this chart captures the exact exhaustion point at 66,000. Upward localized liquidity completely dries up. With the upward resistance removed, the path of least resistance violently flips to the downside. The reversal is immediate. The price begins to fall and strikes the first thin resting tier of leveraged liquidations. On this heat map, you can see the initial strike forming a sharp red candle, plunging straight down from 66,000 toward the 64,500 support level. This initial strike triggers the precise automated sell order chain reaction we just modeled. Following the drop on this chart, watch the velocity accelerate as the asset tears through the densest core of the leverage pools, eventually bottoming out near 63,500. During these events, algorithmic market makers detect the incoming volatility and simultaneously withdraw their bid liquidity. This absence of buyers accelerates the plunge even further. In under 12 hours, the market dropped over $2,000. The July 27th collapse was simply the mechanical release of kinetic energy stored over the preceding days by over-leveraged longs. Examining this post-crash heat map, the price shows a slight recovery towards 64,500. Notice the complete absence of the high-density resistance bands that previously sat above 66,000. These empty visual voids represent neutralized risk. The dangerous systemic fragility has been successfully purged from the order book. Moving forward to July 29th, this chart shows the market settling back into a balanced equilibrium, with new, dense liquidation clusters forming symmetrically right at the 64,500 level. This symmetrical distribution indicates a healthy, localized resting state. The book is stable again, pausing before the next leverage cycle begins. Forced liquidation crashes, while violent on a chart, are highly efficient mechanical processes required to clear structural debt and restore equilibrium. The derivative heat map is not a crystal ball for price prediction. It is a topographical map measuring stored potential energy. This animation of the week's data reveals the organic, breathing nature of market microstructure. You can see the risk gradients shifting dynamically as leverage builds up, holds tension, and ultimately collapses. There is a sharp dichotomy between fundamental market drivers and these structural mechanics. Fundamental news dictates the long-term macro trend, but the physical location of structural liquidation clusters strictly dictates short-term execution and volatility. To survive algorithmic order flow, you must map the resting risk before you attempt to map the trend.